I remember sitting across from this client who was frustrated because I was trying to optimize for retirement that he didn't actually want. Hey everyone, I'm Andrew. I'm a CFA charter holder and a CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I take the learnings from those and I give them to you so that you can apply them to your own. Today's going to be the first part in a multi-part series on optimizing your retirement as a high net worth investor. And it has to be multi-part because what I hope you will see from these videos is that optimization occurs within the guardrails that we give it. And I had this client once who I was going through telling them, hey, here's how we can make things really tax efficient. We're going to set up a S&P 500 separately managed account for you. There's going to be a lot of tax loss harvesting. You want to do some charitable giving. So we're going to set up a donor advised fund. We're going to give for 5 years into that to where we're doing a lot of giving 1 year, very little giving the next 4, a lot of giving 1 year, kind of going down the line. And it ended up where they're just frustrated. And they said, Andrew, at the end of the day, I care about returns. I'm understanding that you're talking about charitable goals. I understand that you're talking about legacy and how do I give to my kids correctly. I understand you're talking about taxes and being tax efficient. I want the highest possible return that I can get. And this was a person who had multiple advanced degrees in finance and economics. They understood that with the possibility of more risk came the possibility of more return, but there was more risk. So it wasn't, the person saying, give me a 20% return guaranteed or anything like that. But for them, the game was, I understand I'm going to have to take risk, but I want the highest possible return given the risk I take. So the tax efficiency doesn't matter as much at that point because we've changed the guardrails with which we're planning for retirement. They wanted the 5 million, even with their income distribution, to be significantly higher than the other person might want it to be. And there are only so many levers you can pull in a retirement plan. You can be tax efficient, cost efficient, risk efficient, philanthropic, and charitable. And that's about it. And so while some people want to do income ladders for their fixed income, this person only saw it as a drag on returns. And they said, no, I'm going to stay fully invested. I'm optimizing for this. And if you zoom out, even the way you construct an investment policy changes given that. The highest possible return you can have is a private business that you own, that you control. It's not unrealistic to see small private businesses grow at 20-25% per annum. And once you hit certain EBITDA levels, the multiple on your business goes up. And when private equity starts to get interested, you can jump from a 4 or 5 multiple of EBITDA to 7 or 8. And the internal rates of return are significant at that point. If you don't have a private business, then you look at things like venture capital and private equity, where it's not unrealistic to see internal rates of return in the 15 to 25% range, but a much higher dispersion in returns. Did you hear that? That was a limb falling. Much higher dispersion in returns too, but again, this client wanted the highest possible return. So when you look at that, then it becomes a game of have as much private market exposure as you can tolerate from a liquidity perspective, and then just enough public market exposure to provide liquidity for income distribution. And even within the public market exposure, you probably want to do things like small cap stocks, technology, looking at factor premia long-term, the highest possible returns. Momentum investing is another one. They didn't care as much about tax efficiency because they wanted the possibility of a 20-25% rate of return. Even post-tax, that's a higher rate of return than your S&P 500 fund. With more risk, but they had eyes wide open what they were doing. and said, if that goes poorly, we're still fine. And I'm wanting to grow this portfolio as much as I can. And so they actually ended up with a pretty significant concentration in private businesses that they owned, private equity, some venture capital, and some simple public market exposure to large and small cap stocks, momentum on the large cap side, value and profitability on the small cap side. Same net worth, you could have a person with a completely different goal and outcome. Beauty is in the eye of the beholder. Retirement optimization is similar. And so what you have to ask yourself is, what does optimize mean to me? And what are the things that I care about? For this person, when you take it to the logical conclusion, you find the highest possible returning assets you can. And then you say, okay, we need some liquidity for income. What's the minimum amount of liquidity that we have to have? To other people, that may sound absolutely insane, but for this person, that's what optimization meant to them based on their goals and what their family valued. Until next time, hope it was helpful to hear that. Talk to y'all soon.